Many Indians returning from US assume the safest option is to keep their house, rent it for a few years and sell once they are certain they will not move back. It does sound sensible. You preserve the option of returning, the tenant helps with the mortgage, and you continue participating in the US property market. But this apparently flexible decision can quietly become expensive. Once you move to India, your RNO's tax status window starts closing. Rental income may eventually need to be reported in two countries. Depreciation can increase the taxable gain when you sell, and a change in US tax or immigration status can even affect the cash available at closing. The house did not change. The consequences of your decisions change the financial outcome. In this video, I will help you evaluate three broad options: sell before or soon after leaving, rent after moving to India, or hold the house because you genuinely expect to return. More importantly, I will show you why this is not simply a real estate decision. It is tax, liquidity, residency, and return to India planning decision. I am Varat and I help US based Indians make smarter financial decisions before and after returning back to India. Let us begin with the tax benefit that many homeowners risk losing simply because they wait. Consider Amit and Neha. They bought their New Jersey home for $6,000 after eligible improvements and transaction costs. Assume their adjusted cost basis is $650,000. Today, the house is worth approximately $950,000, leaving them with a potential gain of about $300,000. They are returning to Bangalore, but they are unsure whether the move will be permanent. So they are thinking, we will rent the house for a few years and decide later. This is where Section 121 becomes important. An eligible individual may generally exclude up to $250,000 of gain from sale of principal residence. For a certain MFJs, which is married couples filing jointly, the exclusion may be as high as $500,000. But you must generally have owned and used the property as your principal residence for at least 2 years during the 5-year period ending on the date of sale. IRS does not simply ask whether the house was once your primary residence. It looks backwards from the date on which you sell. If Amit and Neha move out and sell within roughly 3 years, they may still satisfy the use test, depending on their exact dates and circumstances. But if they continue postponing the sale, they may eventually move outside the eligibility window. The house did not change. The calendar timing changed the tax result. This does not mean every returning family should sell immediately. It means you should know the eligibility deadline before deciding to wait. Amit and Neha may decide to rent for 2 years and sell before Section 121 window closes. That can be a reasonable strategy, but many homeowners evaluate the decision using rent shown on Zillow or quoted by a broker. Suppose the expected rent is $4,500 per month or $54,000 per year. That sounds attractive, but gross rent is not your return. From that amount, you may need to pay property taxes, insurance, mortgages, interest, repairs, vacancy cost, homeowner association charges, property management fees, and tax compliance expenses. You should also maintain a reserve for larger costs such as roof, heating systems, or major appliance replacement. After including these expenses, a property generating $54,000 of rent may produce much less usable cash. If the mortgage is still large, the immediate cash flow may be close to zero or negative. That does not automatically make renting decision a bad decision. The mortgage may reduce, the property may appreciate, and retaining the home may preserve the option to return. Those are real benefits, but they are not rental income. Ask yourself one question. If you did not already own this house, would you invest this much money into exact US rental property while living permanently in India? There is another cost that many first time landlords discover: depreciation. Once a property is placed into rental use, the building proportion may generally be depreciated. Under US tax rules, this reduces the taxable rental income reported each year. But depreciation also reduces property's adjusted tax basis. When the house is eventually sold, gain attributable to depreciation allowed or allowable generally cannot be protected by the Section 121 exclusion. The phrase allowed or allowable matters. Failing to claim depreciation does not necessarily avoid issue. the IRS may still reduce the basis by depreciation that should have been claimed. The related gain may be taxed as unrecaptured Section 1250 gain, potentially at a federal rate of up to 25%, depending on taxpayers' circumstances. So, depreciation can reduce rental income today and increase taxable gain later. It is a timing benefit, not free money. Importantly, converting the property into rental does not automatically destroy the home sale exclusion. If you still satisfy the ownership and use tests when you sell, you may remain eligible subject to other rules. But the eligibility window continues moving, and depreciation related gain generally remains taxable. The planning implication is simple: know your dates, projected gain, and likely sell deadline before you rent the property. So far, we have mainly discussed the US side. Once Amit and Neha move to India, their Indian tax residency status also becomes relevant. Some returning NRIs may initially qualify as RNOR, resident but not ordinarily resident. During this period, ordinary foreign rental income may generally remain outside the Indian taxation, subject to precise facts and applicable laws. But RNOR is temporary and the duration should never be assumed. It depends on person's historical residence and days of stay in India. Once Amit and Neha become resident and ordinary resident, which is ROR, India generally taxes worldwide income. Their US rental income may then need to be reported in India as well as in the US. India also tends to offer fewer meaningful deduction against the foreign rental income. So in many cases, you can end up paying taxes on most of the gross rent and still have negative cash flow after real world property expenses. Foreign tax credit provisions may help reduce double taxation, but not taxed twice does not mean reported only once. The income may need to be calculated under two systems. Tax years may not align. Deductions may differ. Foreign tax credit timing may need to be reconciled, and foreign asset reporting may become relevant. What looked like a simple rental property can become a recurring cross-border compliance exercise. Now assume Amit and Neha kept the property for 5 years and settled permanently in India. One spouse may abandon green card, or they may have originally lived in the US on a work visa and later become non-resident aliens for US tax purposes. When they usually sell, FIRPTA, that is Foreign Investment in Real Estate Property Tax Act, may apply. Under this act, when a foreign person sells US real estate property, the buyer is generally required to withhold 15% of the amount realized, subject to exceptions and possible reductions. This is not necessarily the seller's final tax liability. It is a withholding mechanism. It can significantly affect liquidity at closing. If property sells for $1 million, the withholding could be $150,000. It is based broadly on the amount realized, not merely on the profit. Even if the final tax liability is lower, a substantial amount may remain withheld until the required process is completed and any refund is obtained. A withholding certificate may sometimes reduce the amount, but that requires planning before closing. So the order matters. When you sell, when will your US tax residency change? Will you still hold green card? And could FRPT apply on the sale date? This is not only tax issue, it is also liquidity issue at closing. The third option is to retain the house without renting it. This may make sense when your move to India is genuinely temporary. Perhaps the family is taking a 2-year transfer, the children may return, or they simply need time to test whether India works for them. Keeping the US house preserves flexibility, but that flexibility has a cost. The family continues paying the mortgage, property tax, insurance, maintenance, utilities, and possibly additional expenses because the property is vacant. Meanwhile, the house generates no rent and Section 121 timeline continues moving. Holding the property vacant is not doing nothing. It is purchasing the option to return to US. That option may be worth paying for, but it needs both value and deadline. For example, we are comfortable carrying the property for 18 months while we test the move. If we decide not to return by then, we will sell before a specified date. That is a plan. We will keep it for now and see what happens is not a plan. A CPA can help calculate the tax, a realtor can estimate the sale price, a property manager can estimate the rent, but none of those numbers by themselves answer the most important question. Does keeping this property support family's life after returning to India? Amit and Neha may need liquidity to purchase a home in Bangalore. They may want to fund their children's education. They may already have most of their wealth concentrated in US retirement accounts, RSUs, taxable brokerage accounts, and US real estate. Alternatively, they may want substantial dollar exposure because their children are US citizens and may eventually study or settle there. Keeping the house may also preserve a meaningful option to return. In one family, selling may improve liquidity and reduce concentration risk. In another family, retaining the house may support future dollar expenses and provide valuable flexibility. The same house can produce different answers for different families. Your US property decision is not simply a view on the housing market, it is part of your complete cross border financial plan. Before choosing to sell, rent, or hold, compare these four outcomes. First, the net cash available if you sell today. Start with the realistic sale price and then deduct the mortgage payoff, selling cost, and estimated taxes while accounting for any home sale exclusions available. The number that matters is not the headline property value, it is the amount that actually reaches your bank account. 2. The genuine annual return if you rent. Subtract management cost, vacancy, repairs, taxes, mortgage, interests, compliance expenses, and reserve for large repairs. Keep cash flows, mortgage principal reduction, and expected appreciation separate. Third, the estimated after tax outcome if you sell later. Account for Section 121 window, depreciation, possible US and Indian tax, your immigration status, and any FRPTA exposure. The decision to wait should be based on what you may retain after tax, not only on the future sale price. 4. The value of preserving the option to return. How likely are you to return the same city? Would you genuinely want to live in the same house? What would it cost to buy a similar property later? And for how long are you willing to pay to preserve that flexibility? Once these four outcomes are compared together, the decision usually becomes much clearer. The biggest mistake is not necessarily choosing wrong option. It is postponing the analysis until your choices have already narrowed. Before moving, collect your purchase documents, record of capital improvements, mortgage statement, expected selling costs, realistic rental estimate, and annual property expenses. Also note the exact dates on which you owned and occupied the home, your expected move date, Indian tax residency timeline, and anticipated US immigration status when the property may eventually be sold. Then compare the three routes on an after tax basis: sell before or soon after leaving, rent after returning to India, or hold temporarily because you have realistic possibility of returning. Our team helps US based Indian families build this comparison and fit the property decision into rest of their return to India plan, including their US investments, retirement accounts, India liquidity retirements, children's future goals, and long-term currency exposure. You can download our US property return to India decision worksheet using the link in the below description. And if your return is approaching and the property represents a meaningful part of your total net worth, you can apply for a cross-border financial planning review with our team. Do this before listing the property, before signing a long-term lease, and ideally before leaving the US. Because for returning family, a US house is not merely an asset that needs a tenant or a buyer. It is a tax, liquidity, immigration, and life planning decision. The right option is not simply sell, rent, or hold. It is the option that best supports the life you are returning to India to build. That's it from me today. I'll see you in the next. Also join my NRI only WhatsApp community through link in the description. Thank you.